Ever wondered where the smart money in India is heading right now? Hi, I'm Aditi Jain and today I'm pulling back the curtain on private credit, possibly the most exciting yet overlooked opportunity in your investment portfolio. Let's cut to the chase. Private credit emerged when banks got cold feet after 2008. Banks went into a retreat from lending to businesses, regulations tightened, and suddenly growing businesses are left wondering who's going to fund us now. That's where private credit steps in and direct loans to businesses were made available. Not traded on any exchange, typically spanning 3 to 7 years, and interest rates that adjust with the market. Think of it as a sophisticated cousin of traditional debt, more flexible, more tailored, and potentially more rewarding. So, how do you access this? Through private credit funds. Essentially, investment vehicles where experts do the heavy lifting. They find the opportunities, structure the deals, and actively manage the risks. And trust me, you want these experts by your side. They have relationships, the sector knowledge, and the underwriting experience that would take decades to build individually. They are essentially creating a curated portfolio of loans that you simply couldn't access on your own. Now let's talk numbers because that's why we are here. In India, private credit is outperforming traditional fixed income by 4 to 6 percentage points. It's seeing 14 to 16% IRR on forming credit strategies. And in case of special opportunities, these can be north of 18%. I know what you're thinking. Higher returns means higher risk. Not necessarily. These funds employ a sophisticated risk playbook. First, most loans are backed by hard assets, real estate, equipment, things that you can touch and sell if needed. Second, they use carefully crafted covenants. Think of them as early warning systems that prevent borrowers from making risky moves. Third, and this is crucial, many borrowers have private equity backers with deep pockets who can step in during the tough times. And finally, the diversification across sectors creates a natural hedge against concentrated risks. It's like having a safety net beneath your safety net. Why am I particularly excited about private credit in India? Because the math is compelling. India's economy is growing at over 7% annually while facing a $330 billion credit gap for mid-sized companies. Companies that are too large for microfinance but too small for traditional banks. Add to that the game-changing insolvency and bankruptcy code that finally gives lenders real teeth. And you have a perfect storm of opportunity. If you are considering the space, focus on established players who have proven themselves. Firms like Middlewise and Neo have built impressive track records in local market. International players like Bearings bring global expertise with local execution capabilities. These aren't startups, they are sophisticated operators who have navigated through multiple credit cycles successfully. Private credit in India offers what every sophisticated portfolio needs: income diversification and exposure to growth that's increasingly hard to find elsewhere. Message me and I'd be happy to discuss how we might incorporate this strategy into your portfolio. Thank you.